Welcome to Real Estate Done Rightish, your favorite podcast for realtors by realtors. I'm Jen.
And I'm Annalie. And for a combined 30 years, we've been working in this industry just trying to figure it out. And by figuring it out,
we mean our cars have become mobile offices with better staging inventory than most furniture stores. I feel like that's accurate.
Yeah.
Do you have staging gear in your car right now?
No.
Oh. I'm pretty sure last time I was in your car, the whole trunk was full of stuff.
Maybe.
Do you remember that? I have one painting in my car right now.
I almost stole the painting that's over my bed to go over someone's bed last week.
Yeah, that's a real thing. You like borrow stuff from your own house.
Yeah.
Clients don't know we do that.
Yeah.
If you're listening, clients, these are the things we do. We're like, I don't need a duvet cover. You can use my bed sheets.
Okay, well, let's not.
I'm kidding. I don't do that. I don't.
We can just buy new bed sheets. It's okay.
We needed to start with a little levity because today's episode is going to be deep. But before we talk about today's episode, let me give you a little reminder. If you're enjoying the podcast, please do us a favor, hit the follow button, give us a 5-star review, and tell your neighbors about how amazing this podcast is.
Your neighbors.
Or your favorite bartender.
Okay.
You know, I mean, whoever, really.
Yeah. Well, let's talk about what we're talking about today.
Okay.
We are doing our first state of the market for May 2025. This says 2024. I hope we're actually talking about...
We're talking about 25. We're not going back in time.
Perfect.
Yeah.
Okay.
I mean, we're not going that far back in time.
And we don't know how this one will look every month. It might look different. Mm-hmm. We thought we'd start really high level and talk about what are the economic factors that we watch or that we should be watching if we're not. We learned some things preparing for this show for sure. You'll hear where our strengths and weaknesses are as we're going through this. But really, what are the factors that are potentially putting pressures on buyers and sellers right now, and what might that look like? And so we're going to try to kind of keep it high level-ish today, talking about what are those things we should be watching, what do they mean, and how does that potentially affect consumers? In the future, we might just be talking about what's actually going on in these different areas economically.
Yeah. So economically, I will dabble in politics a little bit because it's affecting economic policies right now. What's happening politically? Tariffs as one example.
Yeah, I would say political policies are affecting economic factors.
Yeah. So... And these are relevant conversations that we're having with clients right now that are coming up. So we'll just be talking about how do we have these conversations? How do you remain professional? And we'll get into that when we get into it. But it is going to be meaty. It's going to be meaty. And we would encourage you to just breathe with us. This will be easy to listen to and just like glaze over, I think. Not because we're boring. We're going to make this so fun, but because it's dense. It's dense information. And I know, and I don't mean this as a slam on realtors, but I think it's pretty easy to be like, well, that's not really my concern. And just like, blah, we're like super fast moving people. And just like somebody else will get the news. But man, when you can sit down at a kitchen table with some clients and at least have a framework of understanding for what's happening so you don't sound like a bumbling somebody, we don't need to be like a guru in all of these, but this does impact the real estate market, and it impacts our clients because it impacts their buying power and their consumer behavior and all of that. So yeah, it's important stuff, I think.
For sure. I think also if you like this kind of thing, we talk about finding your authentic person or your authentic self. If you like numbers and this speaks to you and this always feels to me like the solid part of real estate. There's so much that's fluid and moving all of the time. This is something that's like data that you can grab onto. These are great elevator speeches. Mm-hmm. Someone's like, you're in real estate. What's going on in the market? Instead of saying like, oh, it's a great time to be in the market, like a really generic thing, saying, well, we've got a lot of volatility based on X, Y, and Z, and here's what it's doing, and here's how I'm seeing it affect my buyers and then my sellers. And you can have a 1-minute elevator speech that gives somebody a snapshot that makes you sound probably smarter than you are. That I think that this stuff makes me sound smarter than I am, for sure.
Well, and again, so we're going to go through several, how many do we have here? We're going to go through several variables within the economy. Mm-hmm. We're going to break down what they are, what's currently happening, and just explain how it's relevant. Again, the point is when you get to a client meeting, to even be able to hang in the conversation and say, oh, and we're also going to give you resources on where to stay up to date on this. So we're going to give these podcast episodes once a month, but in between that time, we want you all to feel empowered to know where to go to get this information so that you can just once a day, if your job was every morning, I'm going to have a cup of coffee, I'm going to take 15 minutes. It doesn't have to take that long to get up to speed once you have an understanding of what the variables are. And then you can hang in the conversation with clients. Yeah. Okay.
Yes.
Big enough setup. Let's go.
Okay. Let's dive in. Okay. So number one, interest rates and mortgage interest rates. So what is an interest rate? It's the cost of borrowing money, right? That's expressed as a percentage of the loan amount. For home buyers specifically, mortgage rates obviously directly impact monthly payments and then affordability, right?
Yeah.
How much can you afford based on your monthly payment, purchasing power?
And again, we're just going to really break this down. You're seeing this. So we just gave you a bland definition, but the way that this fleshes out, it's super basic. But when interest rates go up, you have a buyer right now. Let's say they're a first-time home buyer. We've seen this, that all of a sudden it goes up, I don't know, 0.5 percentage point, and it just prices them out of the price range that they were looking at. So now they have to adjust what they're looking to buy. They might have to completely adjust expectations.
For sure.
It can be a really big deal. Yeah. Okay.
Yeah. I mean, even let's say typically the lower the price point the buyer is in, the more this is going to affect them. Not always, because there's a lot of different reasons why people might be looking at different price points, but that's a pretty good rule of thumb that first-time home buyers are going to be affected the most. Mm-hmm. Lower price point buyers, single buyers are going to be affected the most. And then moving up, they might affect that buyer a little bit less.
And it's good. It's important to, especially as we're seeing a lot that could impact interest rates, and we'll talk about what those things that could impact interest rates. If you have a buyer that's under contract and that hasn't locked in their rate yet, that's another thing. It's like, okay, we've got to keep a close pulse on this, because if we think they're going to jump up and all of a sudden they can't afford the house that we've just had an accepted offer on, again, it's important for us to be in tune on these things.
Yeah, I think disclaimer, I would touch those conversations wouldn't touch them with a 10-foot pole. Really. I mean, we don't want to predict the future. We don't want to be lenders. So yeah, I would be very careful, but
we don't want to be in the dark is what I'm saying.
Yes.
You don't want to be like, what's happening with rates? Like, you don't want to be caught. What's the phrase? Caught with your pants down.
Of course, that was the one you chose. Yes. Yeah, that's a phrase. Okay. So what are some things that do affect interest rates? Well, this is where we just got in kind of the dark.
We got schooled this morning.
Well, we just went a little deeper on really understanding mortgage bonds, or the secondary mortgage market, and then treasury bonds, and how those inform or compare, contrast, inform all of the things, the mortgage rates. So what's happening right now in bond markets? Mortgage bond prices recently recovered from lows. Mortgage bond prices and interest rates are typically inverse of one another.
Related, yeah. So I'm going to break this down. Let me see if I'm getting this right. So mortgage bond, I was like, okay, what's the difference? What's a mortgage rate? What's a mortgage bond? What's a mortgage? They're all different things. A mortgage bond is when, so I buy a house and I have a new mortgage. And let's say it has a low interest rate. And Annalie buys a house and she has a mortgage, and we have 100 other friends, and they all buy houses, and we're just using the example right now that they have low interest rates. So somebody will take all of those mortgages and put them into a package together, and we call that a mortgage bond. And there's a mortgage bond market or a secondary market. So investors will come in and say, I want to invest in that mortgage bond or in that group of mortgages that's for sale. Did I get it?
Yep.
Okay. So
I think I think so.
Yeah.
I mean, please correct us. We would love for you to write in and let us know, because we're
figuring it out together.
We're all learning some of these things together.
Okay.
I have not paid as close attention to these specific numbers as some of the other things. So this is great.
Yeah.
So yes, I think that is a good.
So what's interesting, so mortgage bonds, okay, and then treasury bonds. You correct me if I'm wrong, or do you want to explain what they are?
Go ahead. Yep, you're doing great.
This is like me being, they say that you learn best when you teach a thing. This is the first time I'm trying to teach it, so here we go. So treasury bond is a group of what?
Well,
It's the government borrowing money from from investors. So it's backwards borrowing. Instead of us borrowing money from the government is going to investors and seeing how they can borrow money from investors.
they're selling a bond, quote unquote, at an interest rate.
And a bond is a group of loans.
So there's two bond markets.
Yep.
There's the mortgage bond market.
Yep.
That's mortgage-backed securities, meaning it's selling packages of mortgages.
Yep.
There's the treasury bond market. That's a government utilizing consumers or investors to borrow money.
So the government is saying, hey, we need to borrow money now because we're in debt. The government's in debt. The government says
They just want some money.
Okay, or they
Doesn't
just want,
matter.
yeah, we'll just say they're in debt or they're not. They want to borrow money, so they go to the treasury bonds to borrow the money. Now, treasury bond and mortgage bonds are in the same market. They're competing.
They're competing in the same marketplace-ish.
Yeah. So those two things tend to react to one another inversely.
Correct. So, yeah, when bond prices go up, mortgage rates typically come down. This happens because treasury bonds and mortgage-backed securities are competing for investor dollars in the same marketplace.
Yeah, what were you just saying? Yeah.
Yeah.
Okay. Okay, we're looking at each other and I'm like, okay, so let's break this down. Like, why?
Okay, so when investors buy, let's say they buy more mortgage bonds,
Yep.
okay, then their prices rise because it's supply and demand. So if they're going to that mortgage bond market, those bond prices are going to rise. Just like when people go to the stock market, it pushes prices up,
Just
right?
like
It's
right
supply and
now in
demand.
our market, there's more buyers for than their houses, so prices go up.
Yes.
Yeah. Okay.
As bond prices rise, their yields, the return on investment, fall. They get less.
Yeah.
The yield gets less. Since lenders set mortgage rates based on the yield, mortgage rates will also fall.
Got it.
Okay. So think of it as like a seesaw. If bond prices are on one side and mortgage rates are on the other. So when bond prices go up, and that's either mortgage-backed security bonds or treasury bonds, when bond prices are rising, mortgage rates typically are going to fall after.
Okay.
Okay. So why is that important to consumers? Well, mortgage rates aren't important to consumers. So if we're watching the bond markets,
Yep.
that will help predict the future of the mortgage market. It's not going to be immediate. It might be within a day or two, or it might be within a week or two, depending on. So knowing what could affect those bond markets, and again, this is the one, we're starting with the one that I am the least comfortable talking about.
Don't worry, we're gonna get so much smarter as this episode goes on. It's tricky.
Is mortgage and treasury bonds are both there. It's a little confusing in my brain still, and I know that that's probably for some people out there. They're like, "What? This is the easiest thing." It's just one that I have not paid super close attention to, but it is something that is intrinsically connected to mortgage interest rates, and trying to know where they're going and looking for every factor to help us predict where mortgage interest rates are going. Helpful when we're talking to our consumers.
Yeah.
Right. And we never want to say, I saw a lot of people saying, date the rate, marry the rate, marry the home, or whatever.
Marry them.
Is that what it was? Anyway,
Date the rate. The idea was like, hey, so who cares if the interest rate is high? You can refi later.
or like refi in the next year. I'm always very careful to try to predict the market, right? I'm not a crystal ball. I literally say this to clients. I say, I'm not a soothsayer and I forgot my crystal ball at home.
Yeah.
Here's what I do know.
Yeah.
Economists are saying this, or this is what's affecting treasury bonds and mortgage-backed securities right now. And when those go down, mortgage rates go up, or,
Vice versa,
starting to be able to talk about those points of saying, this is what I do know. And this is how it could affect you as a consumer. That's kind of what we're trying to get to today.
Okay, two things I just want to say. I think right now, if you're an agent, you're listening to this, and this is like, whoa, overwhelming. It's a lot. I am in this situation. I'm rebuilding my business. I'm relaunching my business. In a lot of ways, I feel like I'm starting over. I haven't been deep into this stuff in years. I was at a high level, but not this way. But what would it take? I already kind of said this, but what would it take every morning just to sit and listen to the first 15 minutes of this episode, or pull up the news for 15 minutes and just, so now the point is, again, for me, I'm thinking I might not plan to bring all of this up at a listing appointment.
No.
If I feel really confident in it, I might, because it's a little, I'm just going to be honest, like it's a little bit of a flex. Like if you're so good at talking about this stuff and you can sit down, somebody's like, wow, it builds a lot of trust if they know that you have this kind of pulse. If it's not your thing, but if you at least have a base of understanding and they bring up a question, you go in with more confidence, and confidence is
100%.
helpful. Okay.
We're going to wrap up number one.
Number one was the interest rates and mortgage rates. Anything else on that besides we can talk about where they can get the information?
I think just preferred lenders is a great place to get information about this. Bank rate is another place to get information about this. And then I think just watching, trusted news outlets. I will say trusted. I don't think there's any perfect news outlet out there. But when you're talking about, again, watching the bond market, watching the bond market and Googling what is affecting the bond market right now. I mean, that would be a point to kind of just be like, oh, this is what's happening right now, right? So, and we'll be doing that in the future. We'll be bringing what is happening to that
and we
market.
are going to do that in this episode as well. Yeah.
We are?
We're going to talk about what's happening right now.
Okay. Number two, what is the Fed doing? The Federal Reserve, often referred to as the Fed. So what did they do? They set federal fund rate, which influences all other interest rates, including mortgages. Their policies aim to control inflation and employment. So they are manipulating the rest of the world through interest rates, right? Or setting the Fed rate. So what's going on right now with the Fed? Or do you have questions about the Fed?
Well, I think I like to break it down in real world examples. And I think the hot example is like the price of eggs right now or the price of anything. So we're seeing inflation go up, 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 up. And then if the Fed lowers the interest rate, then that lowers the cost of borrowing money. And that lowers, in theory, the cost of everything is the idea. But if you lower the rate too much, then maybe you can explain this then. How does that actually makes inflation go crazy?
Well, right, because people are going to buy more.
Yeah.
And the more that we buy, the more inflation is going to go up.
Yeah.
So the reason that we've been battling inflation, I think coming out of the pandemic, for instance, and why interest rates had to go from those low lows, that was to promote spending during the pandemic, right? That's why interest rates dropped so much. We needed to keep the economy moving when there was a lot of uncertainty and when people were losing their jobs or completely furloughed or, whatever was going on with their lives. Coming out of that, we're still fighting inflation, still coming out of that 5 years later. But coming out of that, I think people were emotionally spending, and they weren't necessarily just spending based on economic factors. They were just wanting to live life and go on vacation and spend money. And so it was a little bit different. The Fed was having to make inflation busting decisions with interest rates. They were holding them up a lot longer than people anticipated, which was keeping mortgage rates up longer than people anticipated. So, again, they don't directly set anything. They are looking to kind of keep the economy moving in the healthiest fashion possible or towards healthy numbers at all times. That's kind of their job, if that makes sense, by setting those federal rates. So what's going on with the Fed right now? There is an upcoming Fed meeting, May 6th and 7th. They have no plans to comment until that meeting, which is interesting. Sometimes we will see comments before, and sometimes when those comments come out, mortgage rates will go crazy based on what the anticipation of what's going to happen at the Fed meeting is. We're going to have to wait until the 6th and 7th to watch this.
We talked before we hit the record button on this episode about do we talk about what's happening in politics right now? And I don't think either of us have a desire to go deep into political stuff. But I do think if you're watching the news and if you're sitting down with clients, you are seeing conversations right now about the head of the Federal Reserve, Navarro, and different conversations that are happening about what he should or shouldn't do with the rates. And so whatever your opinion is on it, and I don't know if we want to talk about this now, but
I don't think we need to. I want to understand why they're doing what they're doing or what they're supposed to do. Their job is to try to control inflation and employment numbers to keep the economy in healthy in a healthy state.
Yeah.
And that's not always possible just by that one factor, right? When other factors happen, we go into a recession or we have a boom, but they're just trying to always keep them within certain margins based on what they can control, which is that federal rate.
Okay, well, while we're here, I'm gonna go there with you because we're gonna be real. I'm not asking you to state your political beliefs.
No, I know.
I'm going to ask you to share what you say with clients, because I think that this is the part of the conversation where, like, I was just at a meeting a couple weeks ago, and I'm not going to say what side politically this woman was on, but she had very strong political opinions on how it might have impact the price of her home and thoughts that she had. Mm-hmm. And she kind of volleyed back to me and was like, "What do you think?" And I don't think it's in our best interest or our client's best interest to be spewing. Listen, if you're listening and you really feel like compelled that you have to do that, to each your own. There are certain things that hills that I'm gonna die on, but this is not a hill I'm gonna die on right now in terms of politics and what I'm gonna say to clients in a meeting. I'm gonna say what you said earlier. Which would you share that?
Well, I think that there's one thing if you choose to be political or not in your business, that is a totally different conversation. I think that politics, no matter who it is always going to affect the economy. It's a huge portion of what's happening. And so if a client is talking to me in one tilted way or another, I don't really care I don't care who's in power. I don't care what is happening politically. I care about how that's affecting our economic factors that are going to affect the consumers that I'm going to be working with day to day.
As it relates to real estate.
Correct.
I'm going to say that because I think we both care about what's happening in the world as just human beings. But when it comes to real estate and the business, we're separating those things on purpose.
Yeah. Political economic factors are incredibly important to me in my business, and other political things are also incredibly important to me. They may or may not affect my business, or they may, or how I set up my business. And that's for everybody to decide on their own.
On their own, yeah. But I thought that was a helpful way to explain for people that are feeling like they're getting caught in client meetings and they're like, how do I answer their questions without, maybe we are on two opposite ends of the spectrum. And I think just to say, look,
I really
what we care about right now. Yeah,
I say I don't care about political affiliation or if you like or don't like what's going on. What I do care about is
I'm concerned with
what's going on and how is it going to affect you and your I'll call it your co-consumer. So if you're a seller, how are those decisions going to be affecting your buyer pool, and how do we make sure that we're aware of the political or economic pressures on those people and how they're going to behave? So I just say I don't really care what the affiliation is. I don't care if you love or hate what's going on. What I care about is making sure we are looking at and we understand how those decisions are going to economically affect you and your co-consumer, the other side of your transaction.
Right. This is such a silly thing.
Yeah.
I'm thinking about listeners that are listening right now, and I'm thinking just a nuance in word. If I was going to refine a dialogue to say I'm not concerned about rather than I don't care about, because it's like, of course I know you and I know you care, but okay.
I don't care. No, I'm just
no, but I'm not concerned with is different than like, I don't give a about this. Because that's not the case. You do care. That's not a concern to you in the matter of the conversation.
It's a different conversation.
Yes. Okay. We're clear.
That's the clarity.
Got it.
Okay.
Ready? Is that all we need? Federal Reserve. Did we miss anything on that?
Just again, a lot of people think that the Fed sets mortgage rates. They don't. It's policies that create a ripple effect through the entire economy. So when they raise their funds rate to combat inflation, it becomes more expensive for banks to borrow money. You kind of said this. Banks are going to pass those higher costs to consumers through higher interest rates on all loans, including mortgages. Mm-hmm. Market expectations about future Fed moves. So that we talked about this as well. If the Fed was going to have a press conference 3 days before the meeting, market expectations about what they may or may not talk about, and then what after they talk, what may or may not happen at that meeting, that will create all kinds of. It can cause bond yields to shift. Yeah. It can cause stock market to do all kinds of crazy things, and that's just based on speculation. So you can get information about the Fed and when they're meeting and what they're talking about, or if they are releasing press releases on their website,
Federal Reserve website,
or just watching the news. I mean, this is a new thing. It's not new. I probably just pay attention to it more, but I do feel like people talk about the Fed a lot more. Yeah. And I think that came with the low interest rates during the pandemic and then what's been happening after. I feel like the Fed gets a lot more press than they used to.
Yeah.
Right?
I think you're right.
Or maybe it's just me.
No,
that I'm paying attention.
I'm hearing it. Yeah. All right. Inflation and unemployment. Let's dive in. Inflation. So what is inflation? It measures rising prices across the economy. So I think most people are pretty familiar with that. And employment tracks job creation and unemployment. So why does this matter? You want to explain it?
Sure.
Okay.
Well, bonds, we're back to that bond market that I'm just loving to learn about today. Bonds are particularly sensitive to inflation because inflation erodes the real value of the fixed payments that bonds provide.
Let's break it down one more time. Bonds are sensitive to inflation. So we're talking about mortgage bonds and
treasury bonds.
Treasury bonds. Okay. So these packages of mortgages, I'm sorry, I have to like break it down this way. I'm like imagining like a bunch of little mortgages inside a package.
Think of it like it's the stock market. It's just a different market. It's the bond market. You're buying into a different, you're investing in a different type of market.
Different type of market. That's helpful. Thank you. Okay. Yeah. So bonds are sensitive to inflation because inflation erodes the real value of the fixed payments that bonds provide.
Yeah. So I'm going to go a little, something we didn't talk about. So there are returns, yields in the bond market. The mortgage bond market has different, like time periods that they give those yields or returns back than the treasury market. So they're on a different timeline. Mm-hmm. So, but they're fixed returns when you buy in based on the yield. Like the yield is the return, right? Yep. But that's a number you're going to get back out of your investment. Yep. Okay. That inflation literally erodes the value of that payment coming back to you. Erode meaning it lessens, it weakens what that dollar is worth. It weakens the value of the dollar.
Yeah.
Products cost more.
Yep.
Your dollar is doing less for you, so it erodes that value, and thus it affects those bond markets.
Yep. I think super simple. And so again, if we're coming back to eggs, I'm like, okay, so now eggs cost, let's just say $8 a carton, and I have the same amount of dollars in my hand that I did 5 years ago. My dollar, the value of the dollar has eroded because of inflation. The value of my dollar doesn't go as far. I can buy less eggs because inflation has been going up.
Correct.
Okay, yeah, it's so basic, but I feel like, again, for people to understand, like, what is this? When I say inflation erodes the real value of fixed payments that bonds provide, it feels a lot more confusing to me than when I think about it in terms of eggs.
Okay, so this is going to get even more confusing.
Oh, good.
Are you ready?
I'm ready as I'll ever be.
When investors in those bond markets expect inflation, they start to demand...
When they expect inflation to go up?
Yes.
Okay.
They demand higher yields on those bonds to compensate for the loss of purchasing power. So the supply and demand is going to change so that they're going to want better yields to stay in that bond market. Otherwise, they're going to go invest somewhere else. They're going to want the return to be higher to compensate for that inflation going up. So it changes the supply and demand in that market. That's why it's sensitive to it.
So, but investors don't set the yield, right?
They do through demand. So if I'm going to go invest somewhere else and a bunch of people leave that market, that yield is going to have to come up in order to get people back.
Do you know who determines the yield?
Jen, it's not determined. It's an economic swing. Who determines a house's price? The market. It's a supply and demand. It's not a person saying, this is the yield now.
It's not like the Fed setting a rate and people set mortgage rates. It's
an open market, just like the stock market, just like the housing market. Okay. It's a market.
Okay, got it.
Yeah.
Thanks. I was just thinking of the yield like an interest rate. I was thinking of it as like an investor investing in something and then saying, I want a better rate of return. I was thinking of it like negotiating a rate of return is how I was thinking of it in my head. Mm-hmm, it's not how it works. Got it.
I don't think so.
We're figuring it out together.
So if they are through supply and demand,
Yep.
if they're going to demand higher yields, which that's a hard, if they're going to go choose something else, so
Yep.
through that supply and demand shift, that's going to push bond prices down, which is going to push yields up. Yeah, you got it.
It's like a seesaw.
Because those are a seesaw. And then when yields go up, mortgage rates go up.
So mortgage rates and yield
Follow each other.
Yep.
And
Mortgage
bond
bonds.
prices and yield are
Opposite,
which means bond prices and
And
mortgage rates are
opposite.
correct.
We should make little seesaw diagrams
You really
for
got this.
everybody.
Oh
which
my
two
goodness.
sit on the
If anyone
same
else-
side of the seesaw, and which we should be on a seesaw for this episode.
Probably.
Right now.
My brain is on a seesaw right now. Literally. I'm like, wait, do I know what I'm talking
Okay,
about?
so why does this matter?
So again, this is just kind of a recap, but inflation erodes purchasing power.
Yep.
And then why employment we didn't even really talk about, but I think it's kind of obvious when there's more people that are employed, what happens? There's more demand in the housing market.
Because more people have money to buy houses. Yeah.
And can get approved it's hard to get a mortgage without a job.
And so there were some, like, again, I'm not trying to get political, but I'm just saying there are people right now, the cuts that are being made in the federal government, the potential for immigration,
Exportations
deportation, yeah.
or deportation.
I know I was looking for the same word.
Exportation of humans, that's deportation. That's good Lord.
We said this is a meaty episode today. But yeah, those things are something to just be looking at because, I can't remember the exact number, but when you look at the potential, like if all of that were to happen the way that they're wanting it to happen, the government is wanting it to happen, that would dramatically affect employment. And then how does that impact the economy and who's spending money? And so again, that's like further down the road, and I would not bring that up in a listing appointment. But again, I think it's good for us to have our eyes on what's happening and how this is a web. All of these things impact one another. They're not isolated in any way.
And I think that's a really good point and none of these really, I won't say none of them matter on their own, but they matter a lot less on their own. They matter a lot altogether, right? Because they are intrinsically connected, obviously.
Yep. So you can get this information if you guys want to look at inflation and employment rates, the U.S. Bureau of Labor Statistics, or the BLS, for employment data. Okay.
Yeah. Okay.
All right.
Next.
You guys, we're like halfway through.
Economically, next, the housing supply and demand.
So this is the balance between homes available and buyer interest, how many buyers are out there. And we were talking about this earlier. I mean, this is really specific to your local market, and we're not going to get into specifics. But I do think, just like as one example, I was reading something about Florida recently because of floods and hurricanes and insurance rates, the buyer demand and what insurance companies are willing to insure right now, the buyer demand is going down. So because of that, prices are going down. That's a very different market and I'm sure very hyper-local specific in Florida.
I was gonna say within Florida, yeah.
Yeah.
Not all of Florida.
Compared to what's happening in Minneapolis right now. So again, we're just going to keep reiterating that because we know people are listening all over the nation. Make sure that you're looking at your local level. But so if you're looking at your very local level to figure out supply and demand in your city, in your neighborhood, you can go to your local MLS and pull the stats. And so we're looking at, you want to walk through it?
Well, so you can look at month supply.
Yep.
Which is a number that you can find if you have like a certain MLS system, you'll have InfoSparks that I think a lot of markets throughout the nation have InfoSparks or access to it through their MLS. You can look at any of your markets at the macro level down to a micro level of what is that month supply. So what's the definition of month supply? It's if they put a moratorium on selling houses on X date, the end of a month usually is what I say. How long would it take the current buyer pool to purchase every home on the market? So it's kind of it's also called absorption rate. So how fast would the buyer pool absorb or purchase every home on the market? So 6 months supply or less traditionally has been a seller's market. So
And
under
we say
6 months supply.
traditionally because it's been...
We'll circle back to that.
Okay.
So traditionally, that has been considered a seller's market. Again, I can speak to the Twin Cities. We've been under 2.6 here since 2016, I believe, maybe 2018. We've been in a very, very strong seller's market for a lot of years in the Twin Cities. And so really, really low on that scale. Conversely, or adversely, whatever, the other way, above 6 months, flip-floppy, above 6 months supply would be a buyer's market. Again, I can speak to the Twin Cities. I think the highest number that I pulled on this was December of 2012. We had 12.2 months supply of inventory in the Twin Cities. So that's obviously an incredibly strong buyer's market, right? So understanding that a little bit. Now, I don't know exactly what these numbers are, but economists are saying because, for instance, in the Twin Cities, we've been in such a strong seller's market for so long that 6 months supply of inventory would no longer be like an even market.
Yeah.
That even market line has pulled down to maybe 3 to 4 months. I think 4 to 5 I've seen also. I'm kind of using more 4 to 5 because we've gotten upwards into the 2s and it hasn't felt that different. No. It's been more seasonality slowness. But I tell my clients when I'm talking through this, because I do talk about month supply, if we jumped from 1.8 or 2.2 to 6,
oh my gosh,
that would be the sky is falling. Oh, yeah. We are in a housing crisis. That wouldn't be a shift into a buyer's market. No. It would be a major shift. And so it certainly wouldn't be an even market. So understanding that. The other way to look at this, if you don't know how to find month supply, you can you can get these numbers through your local association. NAR has national numbers or regional numbers you can also find. You can also just go to a micro neighborhood and do a little math. So if you look at like how many homes came to market or are active in the market at a given point in time, divide that by how the average number of homes that went under contract
that have sold within the last month.
So you could use 1 month, or if you wanted to average it out a little bit more, you could do an average of 3 months or 6 months. You can kind of decide how you want to do that. Number of homes available divided by that average number of homes that are going under contract, that's going to be that same number, month supply.
If you take the average over 6 months for what has sold, would you also be taking the average over 6 months for what's available?
Yeah, I think so. I would, but I think that I wouldn't go, well, it depends on if your market has seasonality or not, how far you want to go back, how you want to do that. I know there are agents in our market that do that math for little micro markets or for the whole market and watch it very consistently. I trust InfoSparks and I use that. I'm not using this to make any major decisions. I'm using this to see economically where are we trending. So is that line staying stable? Is it going up or is it going down? Yeah. And then that's what I'm kind of watching and talking to my consumers about. I'm not necessarily they're not making timing to market decisions or major economic decisions for themselves based on that number. So I'm more looking for kind of a high level.
It's really helpful to have for buyers too. Like if they 100%. Say, hey, I'm looking in this specific city, and you pull a month snapshot. Like today, we're looking at this many homes are on the market in the last 30 days. This how many that have gone pending or received offers. We can see how quickly moving the market is for a buyer that's entering to know like how competitive are we going to need to be here potentially. Yeah,
and you can look at that for like very specific price points and things like that. Yeah. So that can be really good as well.
Yeah.
Okay, I think we
bludgeoned that one.
We really went all around on that one.
To the stock market.
Well, no, hold on. So why is it kind of important? Well, inventory and supply and demand are going to affect home prices, which affects affordability, obviously, for buyers. And so limited inventory, high demand, upward pressure on home prices. Think of, again, I use the pandemic because it was such a wild market, but in 2020, 2021, I would go to listing appointments and I would look at competition and there would be 0 homes on the market. I would be like, well, if you went to market today, you would be the only home in your general price range that's in your general size. Like literally there's not another home. So we have no competition, no supply. We knew there was big demand based on buyer activity and buyers out in the marketplace and interest rates. And so what happened? Every home got many, many offers. Prices went up at the highest that they could within appraisal range kind of guidelines. Conversely, if we have a ton of homes on the market, I mentioned December of 2012. If you remember back in 2013, some of you were babies then. I was in the real estate market because we old.
We older.
So you remember that though. I mean, it was, you drive down every block and there'd be 3 to 6 real estate signs, I swear, on every single block. And so tons of inventory, right? What was happening with buyers at that point? Very few people could get pre-approved because of just general economic conditions. unemployment was through the roof, lots of debt, lots of people that just went through foreclosures or bankruptcies that couldn't get approved for a mortgage for a period of time. They were locked out of the mortgage world. And so not a lot of buyers, downward pressure, obviously prices tanked in some areas and in some markets. So,
and I think all of that also informs strategy with selling then. It seems,
of course,
again, so basic, but if you know that there's, in Florida as an example, and you're selling a condo down there right now, your strategy for how to list, sell, market that, stage it, all of those things is going to potentially look different. I mean, I think, in my opinion, some of those things you kind of do no matter what, because you can maximize price and profit in any scenario. But obviously all of these things inform how you advocate for your clients.
Yeah. And how your clients make decisions for
Yep.
sure. So where do you get that info? Again, your local MLS, NAR, your local association, that they will all have those numbers.
Okay. Now do we get to talk about stocks?
Now we get to talk about the stock market.
Yay. That was really, wow. That was actually a genuine noise you just made too. That wasn't even fake.
This is coming from someone who just opened their stocks a few weeks ago and almost had a heart attack. So no. Okay. So what are stock market?
Okay, so we know the stock market. If you guys are watching the news, you know what the stock market is. You know that it's been really volatile lately because there's been a lack of predictability. How decisions are going to be made that are, whether it's the tariffs or political policies or things like that, it's all affecting consumer confidence. It's affecting how investors are investing in the stock market, and it's making it really volatile.
So I will say for this, this is going to be a factor that affects your consumers' wealth potentially. Their long-term, IRAs are affected by this. So long-term wealth strategies, also short-term, if they're, and again, knowing who you're talking to. If you're talking to a day trader, they're going to be having a different experience than somebody who is a set it and forget it long-term, low-risk investor, right? So, but it's going to affect their potential wealth or their current picture of wealth. And then what does that do? It affects their confidence, right? We saw in our market, some agents commenting that a buyer had all of their down payment in the stock market and needed to pause when that little mini crash happened a couple weeks ago. Just needed to pause and I was in the same place. I was getting ready to pull some money and do a different investment, and I was like, "Oh no, I need to wait and let the amount that I still have in there ride the wave of recovery. Otherwise, I'm going to be selling at the low, and that doesn't make any sense." So it changed my confidence. It changed my strategy about my wealth and about my money, right? So understanding what decisions people are going to be making based on what's happening in those markets
thinking
is
about
important.
the boomers too, like this huge generation that may or may not have money in the stock market that's close to retirement and maybe downsizing. They've got these big homes in our city that they're like living in by themselves and thinking about downsizing. And then if X percent of their money is in the stock market. So just having sensitivity to some of those conversations, because like you said, Annie, like we felt it. You felt it that day when you're like, "Oh my God, I just opened my account." Like it's a real thing for people and how they're feeling, and that is a part of what we're navigating. We're not called to be people's therapists, but I do think having sensitivity in these conversations and maybe asking some sensitive questions to help them navigate their decision making.
Yeah, absolutely.
Yeah. Okay.
And then also, this is where you get to be a little bit of a crystal ball. What are those people called? A fortune teller? I know a future seer. What is that called?
Psychic.
Sure, an economic psychic. But right. Okay. So when that crash happened that day, I knew for several of my sellers that were going to be higher end. And we're going to, or one was a higher end investment property, right? Their buyer pool was going to be filled with people that were going to be more affected by big volatility in the stock market than maybe a first-time home buyer market would be. So again, I can say to my sellers, we're going to want to watch this, and we're going to want to be very cognizant and watch your market very closely leading up to going to market to see how is this actually affecting our consumers.
Right.
Are they really pulling out? Are they really, like what we said, is their confidence shattered based on this? And are they pausing or are they not? Because sometimes we think economically something's going to affect somebody, it doesn't. So anyway, so where are we right now with the stock market? this is just a stat I'm going to read. Approximately 30% or 36% of S&P 500 companies are releasing their Q1 2025 earnings this week being the last week of April, first week of May. That includes tech giants, Microsoft, Amazon, Meta, Apple. The NASDAQ has recovered from early April losses and now is higher than it was at the end of March. So that was a dip and we've had some recovery. So again, why does this matter? Strong corporate earnings typically signal economic strength, which can influence the Fed to maintain higher interest rates. So the stock market can inform the Fed. Stock market performance affects consumer wealth and confidence, as we just, again, hammered pretty hard. That's going to affect that demand in the housing supply and demand, right? Confidence equals more demand.
Yep.
And when the stock market is volatile, investors often move money to safer assets like bonds.
Okay, everybody, ding, ding, ding.
We're back to the bond market.
Bonds. Now listen, okay. Break it down, Annie.
Okay, so again, when the stock market is volatile, big investors and small investors, but investors may pull money. They start to see the writing on the wall. They pull money out of the stock market. They move it to a safer asset. The bond markets, I should say, are much less volatile. They're a much safer asset than the stock market, which can be incredibly volatile.
So and bonds what happens sit on the opposite end of the seesaw, right?
Then what?
Well, we're not talking about mortgage bonds. We're talking about treasury bonds right now.
We're talking about both.
Oh, gosh.
Just general bond market.
But they don't both affect mortgage rates the same way. Only one seesaws the mortgage rates. They both seesaw the mortgage rates? Mortgage rates follow the yield. Bam! I got it.
So the cost affects the yield.
Yeah.
Right? And the yield affects mortgage rates.
Got it.
So if there's a big move, now this is talking about that supply and demand shift in the bond market. If there's a big shift to bonds, we're going to go through all that seesawing. We're not going to talk about it right now. And that can lower mortgage rates.
Got it.
So it's something to kind of watch. When the stock market is volatile, that can mean mortgage rates will
That's all you really need to
reduce.
take away. If you don't understand the seesaw thing like me sometimes, stock market is volatile. Investors may move money to safer assets like bonds, and that can lower mortgage rates.
Yep.
So we're just keeping a pulse on that.
And that happened.
Yeah.
When that stock market volatility moment that was extremely volatile, when that drop happened, mortgage rates dropped that week. Right? So that was correct. We were correct in that assessment. Hindsight.
Thank God we're right about something.
So again, how does this affect consumers? Confidence, and then literal down payment funds. I gave you that example. That can be affected. Where to get this info? You can watch Bloomberg, CNBC, Yahoo Finance. I mean, every channel has a ticker. Google. Be careful. You know, there are places that aren't necessarily going to have the most accurate information.
You want to see where it's being sourced from. Yeah. All right. We did it. Number 6. We've got one more, and then we'll talk quick about a couple more things. But this is the last variable, which really looking at public policy and trade. We're lumping into one category. So, what does this mean? There are government regulations that affect housing and international trade policy. So the trade policies and tariffs is kind of the big one right now that we're seeing have an impact on consumer confidence, on prices. If the prices of all of our goods are going up because of the tariffs, how is that affecting our ability to spend? How is that eroding the value of our dollar, which we talked about earlier? So there's still tariff concerns persisting right now. There's ongoing trade negotiations with China, Japan, South Korea, and India. And we're just kind of in that limbo right now.
Yeah, and I just want to point out tariffs and trade's not the only thing that we're talking about here. We're talking about government policies, government regulations. When we were prepping for this, I used the example of there was a rule change or a government policy change in Minneapolis, Minnesota, a couple of years ago, where everything zoned for one unit, so single family residential, 1 unit, the zoning automatically was approved for those lots to be up to 3 units. So what does that policy do to that market? There was concerns. There were concerns about people. People were fighting it because they didn't want everything to turn into a triplex in the city of Minneapolis, and people were kind of going bonkers. There was also options for investors to change what their property looked like, to add a unit, to make a basement a unit without having to get reapproved for zoning changes, which is huge. So that could be a micro policy change that could affect a market. Now, I don't know that it changed that much in our market, but leading up to it, the thought of that change or the thought of that policy change caused some stuff that happened there. So it could be literally any government policy change. We're talking about trade a little bit because that's been causing a lot of things. Tariffs, we could go into tariffs for days. There's a lot of ways that long-term could, if done perfectly, cause for real estate specifically, economic growth and really incredible opportunity economically. Short term, I think what I care more about the short term because I don't know how they're going to play out. I don't know if they're even going to happen, right? I know what's happening today. Right now, they're causing volatility in the markets, which is then trickling. And that's really all they're doing at this exact moment. They could increase costs for building materials, which could make new construction more expensive, which then changes the landscape of every market that has new construction in it. Creating economic uncertainty. I'm just making sure we're touching on all of this. Can affect job security. And then what does that do? That affects housing demand.
I mean, I'm seeing a couple of just within my little circle group, I have one friend that is an entrepreneur and has making goods overseas. And it's like the highest quality, best place that they can get the goods made. And all of a sudden the business was he's like, I cannot do it. So he's essentially jobless. The same with another woman that I was talking to. There's one woman that works she is a major, what's it called when you buy a wardrobe? You buy clothes for a major company,
You're a buyer.
Company. You're a buyer. Thank you.
Yeah, that's the term.
You're a buyer. And I was like, oh my gosh, so how's it going? And she said, well, I'm paid on commission and right now I can't buy anything. So she's just one person, I mean, she's an important person, but there are lots of little stories like that we just, and maybe there's some really positive things happening that I haven't heard too. I don't know. But all of that, if we're what's a tariff? It's really good for us to just, again, understand the basics. So when we're dealing with individuals, we can see how the impacts might be trickling down to them. Yeah.
Yeah. And again, I have not landed on tariff good, tariff bad. I think there's pros and cons to everything.
I mean, I have opinions, but I'm going to keep them to myself.
I think that right now, what we know is what they're doing right now.
Yeah.
And what the concerns are right now.
Yeah.
Right now, they are creating some economic uncertainty. Right now, there are people that do not know what they're, like you said, they're importers or I have a past client who imports leather. Shout out if you're listening. He gave some examples on how monetarily it may not be viable for him to have that business anymore at all if certain tariffs get actually locked in. And so, yeah, I'm just like you, I'm seeing it affect people. That's what I know right now. Yeah. Could there be positive things? Absolutely. Will there be positive things? Probably. Do I know what those are at this moment? No. I know that there's a lot of uncertainty and a lot of confusion about the whole thing.
Let's not do that.
All right.
Okay. We made it through the majors.
Whew. Guys, that was a lot. My brain hurts a little bit. No, I'm going to go restudy the bond markets for the next 6 hours because now I think that every time I think about it, my brain hurts a little bit.
I'm actually going to re-listen to this episode when I'm in the car a few times.
Well, I hope that it makes sense.
I think it'll mostly make sense. Kidding. I was like, I hope it does. When we do these monthly updates, we're not going to do the same thing. This is just the foundation. So in the future, each month we'll go in and we'll just talk about, okay, what's happening right now in the bond market? What's happening right now with employment nationally? Here's where you can find your information locally. And we'll just reference back to this episode. If you're like, wait, what's that thing again? We're not going to go deep dive this every month.
Right.
We're going to just talk what's actually happening real time.
And I think keeping an eye on here's how I kind of look at all of this. I look at these big things, right? These are big national economic things or international economic things that are happening.
Right.
I try to keep my eye on all of those. And then I try to look at now, how are they manifesting in our market?
Yeah.
Are they or are they not?
Yeah.
Because some of them aren't going to matter. There have been things where, like I mentioned earlier, I thought they were going to really push consumers to do one thing. And it did for 2 days.
Yeah.
And then consumers kept plowing forward like nothing was happening. So So really seeing, are they manifesting in your market, watching inventory levels, watching days on market trends, watching price trends, watching multiple offer situations.
Yeah.
If you don't have enough inventory or enough activity going on, get in relationship in your market with people to know on a weekend by weekend basis, what is the market looking like? How many homes are going into multiples? What's, really keeping your pulse, and then keeping your eye on all these things through the news, through other things, and saying, okay, is that affecting people locally, or how is that affecting people locally? And then just have also, real estate agents should love talking to people. Let's get out and talk to the people. How are these things affecting you? Are they? What are you feeling about this? Just having that kind of open conversation.
That's great. Well, while you were saying that, it was reminding me of a few things. So we effectively, when this episode launches, our website will be active. And on there, we have a few things that we're working on. We really actually want to create, part of what we want to create is not just information. We want to create a sense of community. And one thing Annalie and I were talking about the other day, which I'm sure we'll go into more depth later, is the times in our businesses, like a week ago, when we both came in one day, like in tears, like, what are we doing? We didn't need more information. This information is helpful, but in those moments, we actually need somebody to be like, you're doing a good job. You got this. And we can Google till we're blue in the face on getting more information. But one of the things we want to do is create a space for you guys. So on our website, there's even a form on the bottom. It's like, what would be helpful and supportive to you? Whether it is maybe content and information that we're not covering, or if there's other specific things. So a few offerings that we're looking at that we're just kind of putting aside right now, but as a potential monthly membership where we would create this community where you could get in there and say, hey, what's happening in this local market? What are you experiencing? So that'd be a private community for that, where we'd also potentially have like a weekly, like a Q&A time, like an open question, like ask us anything. And then maybe another time, I think sometimes people, like where I go to work or the teams I want to be part of, or where I wanted to do this podcast with you, Annalie, was the energy. It's like, I need that almost more than I need information. I need that community. So we're looking at creating that. So you can check that out if you want to get on the wait list, if you're interested. We want to see if people want that. If you don't, we won't do it. But if you do, we will. That's on our website. And then other thing while this is being aired is that we have a giveaway. Yes. So until May 15th, we have a giveaway. Is it the most amazing gift ever? I mean, probably not, but I think one of our emails says it's better than what you'd win at a carnival if you did like a ring toss over a thing.
I hope. There's no giant bunny rabbit stuffed animal.
No.
The size of a 6-year-old
child. We have some cool
child.
stuff. We've got like a planner and a charger, like a charger block and a bottle of champagne and one of our cool
Yeti mugs.
A Yeti mug that says, I've only cried in my car twice this week. So how you can register for that is you'll see it on our website, and all the things. Okay.
Really banging the table a lot today.
Sorry.
Economics makes Jen bang the table.
I guess I do.
Okay, that's all for this week's episode of Real Estate Done Right-ish.
Wait. Where are we? Well, on the last page. You say it again. Never mind. We're not going to put this in the bloopers. This is actually how it goes. I lost my script. That's what just happened.
That's all for this week's episode of Real Estate Done Right-ish.
Until next time, cheers to doing it right-ish.
We'll try. I'll just do it as fast as it feels, okay? The information, opinions, and recommendations presented in this podcast are for general knowledge and informational purposes only and do not constitute professional, legal, or financial advice. As licensed real estate agents in the state of Minnesota, we are not attorneys, financial advisors, or tax professionals, and we cannot provide advice in those areas or in regards to any agency or broker-specific topics in any other state. Any reliance you place on the information provided in this podcast is strictly at your own risk. We strongly encourage you to consult with qualified professionals for specific guidance related to your individual circumstances.
Wow! That was good. All right. All right. Are you ready for the whopper of...
No, hold on.
This episode is actually a little intimidating.
I just don't like the bond market stuff.
We'll fumble through it.
I'm going to literally be like, this throws my brain into a tizzy, so I'm going to read it verbatim.
How long have these been unbuttoned?
Wait, are all my button? I'm good.
You know what I didn't
haven't
know
popped
about our
any
cute
buttons.
dresses?
And buttons.
And buttons.
You have way more buttons than me, though.
I know, these are a lot of work.
Why did you unbutton them? Do you have to?
This is the first time I've worn the dress.
Oh, that was never buttoned. You've been
Really good thing I didn't walk around without my coat on.
open. Oh, I'm just going to say, like, because this is kind of meaty, I'm just going to read it and then break it down until we both understand it. We're just going to keep reading it and breaking it.
Oh, damn it. I think they're coming undone on their own.
I think you only got half dressed this morning.
I was really looking for a very exciting day today. There's nothing to see here. You can't see those.
Why don't you put your dress on?
It's
I'll reread. I'll just keep studying about treasury bond markets.
Why don't you put your dress on? All right, everybody. I can't. I want you to try it.
How is this start?
It's so much harder than it seems.
Welcome to Real Estate Done Rightish. That's not your. That's you though.
Okay, all right, here we go.